there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. The United Arab Emirates has issued a missile threat warning as rising tensions between the U.S. and Iran continue. The UAE issued the threat after an oil tanker owned by its state oil company was struck by Iranian drones in a separate incident outside the Strait of Hormuz. The warning comes for the first time since a ceasefire began between the U.S. and Iran a month ago. The attack follows U.S. President Donald Trump's plans to restore transit through the waterway and help stranded vessels exit the Persian Gulf. And the federal government has unveiled new measures to help Canadian businesses hit by U.S. tariffs on steel, aluminum, and copper. The $1 billion program will provide financing to impacted firms and will also add $500 million to the existing tariff response initiative. The move is in response to U.S. President Donald Trump's recent 25% surcharge on products that contain the metals. Industry Minister Melanie Joly says Canada must defend its workers and support its businesses.
We know that we can't control the White House. We can't control what's going on south of the border, but we can control what we're doing here at home. The steel, aluminum, and copper sectors are key. They're key, obviously, to our economy, key to our manufacturing sector, but also key to our sovereignty. Should Canada be one day in conflict, we need to be having these capabilities, particularly on the steel and aluminum side. And of course, for everything linked to our electric system and AI, and Evan would know about that, copper is extremely important as well.
Meanwhile, OPEC Plus nations will slightly increase crude production next month as the Iran war continues to impact global oil supply. During a virtual meeting on Sunday, the group decided to raise production by close to 200,000 barrels a day. However, that move is mostly symbolic until the Strait of Hormuz is fully opened. This will be the third consecutive monthly increase by the organization. And we're watching the TSX closely today. Of course, it is down by 0.6% at the moment, below the 34,000 mark still after seeing some losses last week as well. We'll continue to watch that for you. We're also watching U.S. markets today too, obviously. Stocks are falling as we see the price of oil rising. The Dow Jones down by more than a full percentage point at the moment. Markets are proving hard to rattle, even as the Iran war pushes oil prices higher and bond markets flash a warning sign. Strong earnings, booming AI spending, and resilient consumers have kept stocks near all-time highs. So is the rally built to last, or is the clock ticking? Joining us now to unpack this is Zachary Hill, Head of Portfolio Management at Horizon Investments. It's great to have you join us. Thanks so much.
Good to be with you today.
So obviously, we're seeing stocks down quite a bit at the moment, particularly U.S. stocks. But at this point, when does elevated oil prices really become a problem when we're talking about the actual stock markets, or has it already?
Yeah, I mean, I think we see it a little bit in the internals in terms of, the broadening out trade that started, at the end of last year and is really popular for the first 2 months of this year. That trend within markets has certainly been put on pause with what's going on in the Middle East. But broadly speaking, as we look at markets, and especially the U.S. equity market and the top of the market, the tech sector and related, a lot of this is earnings driven. And so while what's going on in the Middle East might be scary and is very, very hard to handicap for energy experts, geopolitical experts, and just for the regular old investor, at the end of the day, a lot of what we're seeing is fundamentally supported. And so I do think that puts a little bit of a floor and makes buyers emerge as we see sell-offs like we're doing today.
Interesting. So then do you think the markets are largely shrugging off the war in Iran if you're saying most of this is earnings driven?
I mean, I think it's a little bit of both. I think, the headline indices, yes, they're shrugging it off, but investors are being selective. They're not treating every stock the same. Certainly, we've seen more earnings power coming from the top of the market in AI-related names. But even, if you look at overall, earnings growth has been quite healthy. And so, we take a step back and we look at all that together. We say that we might not see, the pace of these gains continue from here. But if we do have, a sell-off 5 or 10% from here, I very much expect buyers to be stepping in. If this process goes on for a few months and we have higher oil prices for longer, that's a different story. But right now, as we look at it, things seem pretty fundamentally supported to us.
Just on that note, like if we do get an oil-driven sell-off, do you think the mega cap tech is actually like a safe place to be?
I do, Lindsay. I mean, I think if I look at, where things are priced, what interest rates are doing, and a lot of the defensive sectors like utilities, real estate, staples, they tend to be kind of bond proxies, and bonds just are not working in this cycle. And there's a very good reason for that. We have near-term inflation, and also governments, to the extent that they're offsetting this, are just increasing already very large fiscal deficits. And so you need more of a risk premium, to shoulder that risk. And so you put all that together, mega caps tech earnings have really nothing to do with the price of oil, whereas a lot of the rest of the economy does. And some of those defensive sectors could be very vulnerable from a margin perspective. And so we do think that if we get a sell-off, that mega cap tech will be defensive. And that's a change, from what we saw over the last 6 months. And so I do think that makes that part of the market more attractive.
Okay, you mentioned bonds, and we were just looking at the bond markets there. Bond markets and equity markets seem to be telling two different, very different stories right now. Which one should investors be paying more attention to?
I mean, I think you need to pay attention to both of them, quite frankly. I think what the equity market is saying is that nominal growth is going to be higher, and that's not really making a call whether that's the inflation side of things or the real growth side of things. Just the fact that, corporate earnings are driven by nominal GDP, not real GDP, which is the number that we watch so closely on the economic side of things. And so, the corporate sector is more geared towards the nominal economy, whereas what you're looking at from a debt sustainability and the like, real growth is more important. And so, I think that's a difference. And the part of the reason you've seen stocks recover so much is, one, earnings, but two, that different sensitivity to growth and inflation. Whereas, bonds, not just in the U.S., but really all major markets are at or very near their highs of this cycle. And so I do think that's a notable divergence that we're watching.
Okay, so let's talk about corporate earnings a little more then, because you've mentioned it a couple of times now, and I do want to know, what surprised you most? As you say, it's been pretty strong earnings results from most companies. Is there something that surprised you the most? And what we're seeing in earnings tell us about maybe corporate America?
Yeah, I mean, first of all, the macro commentary by and large has been very good. The financials kicked us off with that. We've seen the credit card companies and the like really talking about, resilience. There's more buffers in the system, I think, than people will often give it credit for. And so the broad macro, backdrop, and at least up until what we've seen right now, is pretty strong. On the tech and AI side of things, I do think, there's been a little bit of a differentiation between, folks that are increasing their CapEx and not getting that bump in revenue to go along with it. That the market does not like. Whereas, if you're able to increase your revenue and use AI to leverage your core business and not have to invest so much dollar for dollar to get that additional revenue growth, that's very attractive for an equity investor. And so, as we look to position portfolios in the months ahead, we think, that the CapEx growers that are not getting the revenue are the ones we probably want to stay away from. Whereas, if you're driving scale in your business by using AI, that's likely to be rewarded by the market. And so we're trying to, kind of dig into different parts of the tech trade to see where there are opportunities to position that way.
Just lastly, I did want to ask you about central banks. You think the Fed is essentially on the sidelines for now. So what does a boring Fed mean for investors this summer?
Yeah, I mean, it's hard to believe because normally, investors think the Fed is on their side, but really, we spend a lot of time going back and forth trying to think about what the Fed is thinking. That's not terribly productive at the end of the day. And so I do think, the Fed is on hold. A boring Fed is a good Fed. There's a lot to play for potentially with, Warsh coming in and trying to change some of the policies. But any of that's happening, as we saw last week, how divided the committee is at this point, any changes that are going to happen are going to be over a very, very long period of time. So by and large, we're not paying as much attention to the Fed. And also from an investment perspective, that's why earnings are all the more important, because you're not going to get that, multiple tailwind coming from easier policy as we sit here today, not just in the U.S., but in the rest of the world. And so you need to go where the earnings are.
Interesting. Okay, we're going to have to leave it there. Zachary Hill, Head of Portfolio Management at Horizon Investments. Appreciate your time. Thanks for joining us. When we come back, we'll tell you how OPEC is managing strained oil supplies after losing one of its key members. That's next. OPEC Plus nations is set to slightly increase crude production next month to around 200,000 barrels a day, following its first meeting without the United Arab Emirates, which officially left the group on May 1st. For more on this, we were joined earlier by Jeremy Irwin, global crude lead at Energy Aspects.
They continued on the path of unwinding those voluntary production quotas as expected. Now, this won't really translate to higher crude exports given the ongoing disruptions in the Strait of Hormuz. But yeah, status quo.
Any conversations about the UAE added, or were those being held in back rooms?
I think the situation with the UAE had been building for some time now. The timing of this announcement is very much taking advantage of the current situation, where there was some concern within the group that their departure would lead to a sell-off in pricing. And now, given the magnitude of disruptions we're seeing currently, obviously that, overshadows their departure, and you didn't really see that downward pricing pressure on crude prices. So I would say that sort of explains the timing from our view.
And so was that the UAE playing nice with OPEC, or?
I think the UAE has had more ambitious growth plans than the group had, allowed them to do so within their framework of managing the market. So I would say, yes, they're taking advantage of the timing of the situation, and I'd say it's a bit of a peace offering in the fact that they are leaving the group. So that's how I would characterize it.
Now, and how much of an impact will it have on OPEC if the UAE, assuming everything is resolved, bumps up their production? I think they want to go from about 4.5 to 5.5 million barrels. What kind of an impact will that have?
Yeah, we would still think OPEC is going to be effective in managing the market. Still, Saudi Arabia has a pretty big bat to swing there, and some of the spare capacity they withhold. So we still think the group will be effective in managing the market. Now, the UAE probably grows a little bit quicker. And, could this have more supply risks down the road? Potentially, but I think that's to be seen. We have to see how Middle East production comes back after all these shut-ins. So there's a lot of unknowns. So I'd say it's a little speculative to assume that it could pressure pricing way in the future.
Now, obviously, more production, more money for the UAE. What are the other benefits, and what might be the shortcomings of them leaving?
Yeah, I think the benefits are exactly what you say. They can grow production without any type of restrictions, and they can sort of maximize those revenues for the country. Now, the shortcomings are probably more contention amongst their membering states and borders. Within the group, I don't think you're going to see any outright conflict there, but maybe some other economic risks to, say, trade agreements or regional trade flows outside of energy.
Because all of their neighbors, I think, are members of OPEC, are they not?
Yeah, essentially.
So what could we possibly see? Trade agreements being torn up, or what else?
I think just more of a hostile negotiation or negotiating type of scenario when you're looking to sign trade agreements outside of oil. So there might be some bad blood and a little bit of contention within the group from disrupting the unity in a time where, a lot of member countries would have emphasized the need for unity in managing the market. So I can't point to anything specific in terms of a specific trade deal that's at risk, but that's sort of how we would frame it.
And from the OPEC side, are there benefits to the UAE leaving, or is it mostly a negative to them?
Yeah, I would say the more market share you control, the larger your ability is going to be to manage that market. So I would characterize it as mostly negatives to be losing some market share, but still they withhold a sizable enough position in global oil markets to be effective.
And the Saudi Arabia and the UAE, they've been kind of jabbing at each other for a while now. Will that continue, or will it heat up, or could it actually cool down?
I think it would probably continue if I had to make an assumption right now. I don't expect it to heat up, but we think it probably continues. And this could be something the Saudis bring up in the future when they're discussing other trade negotiations like we kind of discussed.
And then bigger picture with all this unfolding, with the backdrop of Iran, if and when the strait is reopened, how quickly, because UAE is not involved now with OPEC, how quickly will things get back to normal there?
Yeah, so our basically latest base case is that flows are going to be disrupted through the month of May. And that's largely because oil inventories in Iran and what the U.S. is trying to do by blockading the trade flows to withhold oil revenue to Tehran is going to take about 4 weeks until you see tankage in Karg Island and Iran reach tank tops, which then shuts in their crude production, which then impacts their future oil revenue. So in our view, you're not getting back to pre-conflict levels probably ever, and our current base case would be 50% of pre-conflict transit by end of June. So another month of pretty magnitude and sizable supply losses.
And with Iran, I heard someone say at one point that they're even considering essentially digging ditches and leaving the oils out in the open stored. Is that feasible? Is that doable? Or would it make a difference?
Yeah, I mean, there could be small little workarounds like that, but in the big scheme of things, it's not feasible at the scale they would need it. I mean, they produce over 3 million a day, export as much as 2 million in a good day. So, I mean, it's just not feasible to really create an ad hoc short-term fix for that type of size.
That was Jamie Irwin, global crude lead at Energy Aspects. Well, surging gas prices are reshaping summer travel plans across Canada, with fuel costs up sharply in recent months. Many drivers are now canceling road trips. CTV's Kamal Karamali has more in this report.
This is my 2016 Honda Civic.
This car was supposed to take Care Murphy all over Ontario this summer, planning an anniversary trip with her husband, but soaring gas prices have put the brakes on that plan.
Oh, it's bummer, man. We're so bummed out because this is what we love to do.
A hit to her personal plans and her profession. With her wedding DJ business now potentially switching gears on how far it's willing to go.
Can we, as a small business, feasibly afford to be giving away a free hour of travel to get to somebody's event?
Now, a new survey shows most Canadian drivers are choosing to limit their summer travel because of high gas prices. The poll done for the Tire and Rubber Association of Canada shows roughly 2/3 of Canadian drivers say they will cancel or limit road trips this summer because of high gas prices. Here at this Ontario rest stop, travelers,
we are kind of cutting off the routes we used to make.
Parking their plans.
I have to go all the way to Toronto, so it was crazy.
All of it possibly cooling down summer sales during a time when they're usually heating up. Betty's Pies and Tarts is right off this Ontario highway. Banking on customers spotting them while driving is baked right into the business plan.
We'll see lots of U-turns, pulling over on the side of the shoulder, then, backing up.
But there have already been fewer road trippers so far this year, and there's a worry it'll only get worse.
We're a little bit slower than we have been in years past. If the price of gas does continue to climb, it really could affect our business and the customers that we do see.
The hope here, Canadians will still travel on shorter trips, but long enough for these bakers to bring in the goods and satisfy wandering hearts like this one.
It may just come down to having to accept it and sort of suck it up.
Until summer travel becomes more affordable. Kamal Karamali, CTV News, Port Hope, Ontario.
Coming up, GameStop CEO wants to take over eBay. We will get into the details of that deal right after this. Stay with us. Video game retailer GameStop has announced it has made an offer to acquire eBay at roughly $125 per share, valuing the e-commerce platform at roughly $56 billion. For more on this potential acquisition and what it means for both companies moving forward, we're joined now by Colin Sebastian, Managing Director in Equity Research at Baird. It's great to have you join us. Thanks so much.
Yeah, thank you for having me.
So I'm wondering what you make of this potential deal and how GameStop would actually finance this acquisition.
Well, it certainly would be a stretch for GameStop in terms of issuing a lot of stock and diluting their shareholders, and then, of course, raising a lot of debt. And quite frankly, it's an odd deal because it's one that's structured more like taking over a distressed asset. And eBay right now is not a distressed asset. They're actually doing quite well. So it's an odd proposition, to say the least.
Because the CEO of GameStop was asked this question in an interview a couple of different times and kind of dodged answering it in terms of like where that extra money would come from, right? So like how realistic is that path to actually funding a deal here, do you think?
Well, I don't know if eBay is the ultimate end game for GameStop and Ryan Cohen. I think there could be a lot of other options, and certainly the world knows now that they are looking to make an acquisition. But if this is the specific deal that they would like to do, then it does require a significant dilution of GameStop shareholders, and that means issuing a lot of stock. And that's really the only way we can see that they could afford this deal, in addition to raising the debt, in addition to using the cash. And I think that may be what they may not explicitly want to say.
Do you think shareholders and lenders would support this idea?
It's a really good question, because GameStop has been an anomaly with respect to stocks, in that it's been a meme stock, right? A significant amount of support from retail shareholders, a company that has not done particularly well. It's been a shrinking business, and yet been able to raise a lot of cash in that environment. So I think it's hard to say with GameStop. If Ryan Cohen's able to convince this very rabid shareholder base that buying eBay is the next logical step for GameStop, it's possible that they could get support for it, but we don't think the deal will get done.
Interesting, because as you mentioned too, like GameStop's market cap is a fraction of eBay's size, right? So I know you're not Ryan Cohen, but what do you think gives him and the company kind of the confidence that to even put this idea forward and pitch it?
I think there are some strategic opportunities. If you think about GameStop, that sells a lot of used product as well as collectibles, there is overlap with eBay, and perhaps eBay could introduce new services for sellers and buyers using physical stores. So I think there's a world in which there could be some synergies between the companies. Honestly, I would have thought it might be eBay buying GameStop rather than the reverse happening. But I think that may be the strategic value that they see in combining the two companies.
And Cohen's compensation package will reward him if he pushes GameStop's value above $100 billion, right? So is this the first sign of maybe like more high-risk moves to come on his part?
Well, I think he's highly incentivized to do a deal that helps GameStop achieve those milestones that give or would provide him that compensation. So this may be the first in a line of different propositions that they make, depending upon the outcome of this proposal. So I do think that you might hear a lot more from Ryan Cohen from GameStop before this is all said and done.
And as you mentioned too, near the top, like you don't think this is the end goal for GameStop is just acquiring eBay, right? So like but if they were to have this deal finalized and for this to go through, how would this affect GameStop's kind of like long-term business plan moving forward?
Yeah, honestly, I think it would be more eBay's business plan moving forward. It's more like a takeover of eBay. And that's why it's a little bit odd, because eBay is actually doing quite well right now. This is the type of activist behavior you might see with a company that is undergoing a lot of negative pressure. So I think the vast majority of the company, in addition to the vast majority of the stock, would be eBay. And that would really be the going concern. And the question would be, does GameStop actually fit into the business long term? And that's the question I would be asking.
I mean, I was going to ask you also about eBay just on the flip side. Like, do you think eBay is seriously considering going through with this merger?
I don't think that they would likely want to pursue this particular proposal. There's obviously a price, for every company, but I think given the fact that eBay is doing quite well right now in terms of their own technology transformation, as they call it, given that they believe there's a lot of upside, I don't think that it's likely that they would seriously consider the offer at this price.
Because if they were to consider it, what benefits really would that have for eBay?
Well, shareholders would get paid out half in cash, so that would be perhaps an attractive option for some shareholders. It is a premium to where the stock was trading at last week, so that is another factor. But really, when you propose something like this for a company that's midway through a significant transformation, probably requires a lot more than just that standard premium over the stock price. I think eBay expects to grow earnings quite a bit more over the coming years, and they would prefer to have probably a more significant price in terms of any buyout.
Interesting. Okay, we'll leave it there. Colin Sebastian, Managing Director in Equity Research at Baird. Appreciate your time. Thanks so much for joining us.
Likewise. Thank you.
Thank you. Coming up, how One Toronto REIT is betting on missing middle housing and building rental properties designed to perform in any market. We'll get more from the CEO of Alliance REIT when we come back. Stay with us. The U.S. is denying an Iranian media report about Tehran striking an American naval vessel with missiles. This happened hours after U.S. President Donald Trump said the U.S. will help ships stranded in the Persian Gulf transit the Strait of Hormuz. In response, Iran's military said U.S. forces would be attacked if they entered the strait. The Financial Times is reporting U.S. private equity group Francisco Partners is in talks to buy Moneris. The Canadian payment processor is a joint venture between Royal Bank of Canada and Bank of Montreal. And according to the report, the deal could value Moneris at as much as $2 billion U.S. and may come together by this summer. The Canadian banks put the financial technology venture up for sale just last year. And shares of Tyson Foods are getting a lift today. The company beat estimates for profit and revenue in its latest quarter, driven by sales in its chicken and pork segments. On the downside, Tyson cut its full-year net expenses forecast and saw sales in its beef unit drop 13% year over year. The company has been dealing with soaring beef prices, which has impacted demand. And we're, of course, watching the TSX today. It is trending down by 0.4% at the moment, continuing to see some gains that we saw on Friday. We'll watch that, obviously, throughout the rest of the day. We're also keeping a close eye on U.S. markets. A lot of volatility. The market's trading down today, especially the Dow Jones down by 0.8% at the moment as we're seeing oil prices rising once again. Alliance REIT is expanding its push into Toronto's housing market, focusing on small-scale rental properties, one of the city's tightest and most in-demand areas. Our next guest says the focus isn't market timing, but delivering housing that works in any environment. So for more on their strategy, joining us in studio is Hooman Tabesh, CEO of Alliance REIT. It's great to have you in studio. Thanks for coming in.
Good to be here. Thank you.
So what exactly is Alliance REIT building? Let's just start with that.
So at Alliance REIT, we create housing by taking underutilized properties in the city core, and these could be century-old single-family homes or mixed-use buildings, and we transform them into 4 to 8 unit, well-designed apartment buildings in established and desirable neighborhoods.
Why is this important right now to be doing?
In Toronto, we have a product mismatch problem. I think for the past number of years, the product that was being built wasn't designed for, the demand that existed. What we find is that what people are looking for is for affordable housing in neighborhoods that they want to live in, and that's what we provide.
Which is sounds is easier said than done, right? It's difficult to find. I think you call it the missing middle housing.
That's right. I mean, for the past, I would say for a decade, what's been built are either small condos or high-end rental towers that come with high rents. What we provide are larger, better designed, ground-based apartments in established, desirable neighborhoods that people want to live in at affordable prices. It's a segment of the market that is missing. That's why it's called missing middle, and there's tremendous amount of demand for.
Because you say it's not a supply problem, right?
It really isn't a supply problem. It's a product mismatch problem.
So what does that mean?
It means what's being, what has been built and what the market wants. There's a big gap, and we're trying to fill that gap. People will always choose to live in a hard loft, central apartment with the same amenities as a condo, but in Little Italy, in Little Portugal, at affordable rents. And when there's a choice, renters always choose our product over, a condo or a rental in a tower.
Why is that?
I think it's livability. I think it's design and affordability.
Okay.
And those are what we provide. I think location is very important, but also design. I think investors underestimate the design and livability of an apartment in rental performance.
Is that, I think I've been hearing experts talking about that, right? Particularly the condo market is just, it's becoming too, like the spaces are becoming too small for people to actually want to live in.
Unfortunately, it wasn't built for the end user in mind. It was very much geared towards the investor. And I think, as market cycle turns, we have this tremendous supply, but it's a supply of the wrong product that people are not as interested to live in. People want to live in established neighborhoods. They want to walk out, they go to the bakery, go to this, go to Starbucks, go to the grocery store. They don't want to wait for 12 minutes or 20 minutes for an elevator, or take an Uber to where they need to go. They want to be able to, and this walkability is important. And, Toronto doesn't need another 300 unit tower. What Toronto needs is 1,000 more ground, multiplexes in established neighborhoods, that people could, able to live in. A lot of people are now priced out of a lot of neighborhoods.
Yeah.
What we're able to do is create housing in these neighborhoods that people could afford and enable them to either continue to live in those neighborhoods or to be able to live in those neighborhoods.
Why has this been missing for so long? Like, why hasn't the market had more of this before? This has been typically a mom and pop strategy. From a scale perspective, it hasn't been, something that, institutional. And I think that gap is where Alliance comes in. We're trying to fill that gap between the mom and pop landlords that had spotty property management program and institutional, which typically focus on much larger scale developments. And that gap is where the opportunity is. You say you're also not trying to time the market at any particular time because it's a little unpredictable right now, as I think most people would agree. But how are you trying to keep up with what you're seeing?
It's a great question. I mean, we're not business timing the market. What we're focused on is delivering a product that performs across the cycles. And when the cycle does turn, the best product in the best neighborhood, in the best location, outperforms first and the fastest. And that's where our focus is. We've been very lucky that, we've outperformed the market in the bull market from 2016 to 2022 when we first started in 2016. And we've outperformed in 2022 since. Why? Because we've been able to maintain full occupancy because people always want to live in our apartments. So the demand is there, the product's missing. And we want to be able to fill that demand by creating that supply that we believe the market wants, which would enable our investors to benefit once the market does turn, because we believe that's the product that will outperform first and fastest.
If interest rates stay high, though, or if they go higher, will that affect your model at all?
CMHC has some great programs that we take advantage of. We're focusing on 5 units or more, so we're able to take advantage of CMHC MLI Select. And also, these are buildings that we're able to create under replacement cost. So our costs are always much less than a ground-up development. As a result, we're able to deliver that value to our residents and investors. So even when interest rates go up, most of our, we have some great partners. I think, I want to give a shout out to TD, to BMO, to National. They've been our partners for the past decade. And, we're able to mortgage our stabilized properties at attractive rates where we're still profitable and we're still cash flow positive. And, since we started, we've been cash flow positive, so we continue to do so.
Why Toronto, I'll ask, first of all. I mean, I know that there's a lot of demand here for housing, but why Toronto to start with?
Well, first of all, I'm from Toronto.
Right.
And I truly believe that Toronto has tremendous potential. I mean, from a macro, level, economics speaking, we're center of health, we're center of, we have 3 universities, central finance. I think from an immigration perspective, Toronto it tends to be one of the destination, and even interprovincially, we have a lot of demographics moving to the city. So, and Toronto, if it wants to compete with the livable and walkable cities like Copenhagen, Paris, Soho neighborhood in New York, needs to have more ground-up multiplexes versus more towers, and that's what we want to focus on.
And are you just very quickly before we wrap up, because we're almost out of time, are you looking to expand further potentially in other Canadian cities?
Right now our focus is Toronto because we see a lot of potential in Toronto. We're not finished here.
Got a lot of work to do.
Absolutely. I think Montreal already has a lot of the product that we're building in Toronto. So I think there's tremendous potential for us to continue our expansion in the city.
Okay, we'll leave it there. Appreciate you coming in. Thanks so much for joining us.
Thank you for having me, Lindsay.
That was Hooman Tabesh, CEO of Alliance REIT. When we come back, are Canada's copyright laws entrenching big tech? We'll hear from a digital rights advocate on the push to legalize jailbreaking. That's next. Canadian copyright law treats jailbreaking tech as illegal, even when it's done to repair or modify your own device. Critics say those rules entrench big tech power and stifle competition at a time when other countries are moving to loosen those restrictions. So for more on this, we were joined earlier by Cory Doctorow, Special Advisor to and Electronic Frontier Foundation.
Anti-circumvention just means that if a product is designed to stop you from changing how it works, then we've made it illegal to change it, even if it would otherwise be legal. So in other words, if you have a printer and it's designed to stop you from putting third-party ink in it, generic ink in it, and you change the printer so you can just use your own ink, that becomes a crime in Canada. And it's not like Parliament ever passed the, you have to pay $10,000 a gallon for your colored water Act of, 2011. We just made it illegal to modify printers, and then HP made the printer that only took its ink, and then they raised the price to $10,000 a gallon, making it the most expensive fluid that you can buy as a civilian without getting a government permit. It's pretty weird because, it's yours. You should be able to use it in legal ways.
Are there any other situations like that? I mean, one of the things that might come to mind, auto industry, I mean, people modified cars forever, but now even I think it feels like the auto industry is kind of pushing people towards having to end up at their dealerships to do anything.
Oh, yeah. You hear auto modifying and you think of something like, hot rodding or, tuning the motor or something. No. Like if you want to modify your car so that an independent mechanic can turn your check engine light into a diagnosis, something that if you want to do it through the manufacturer's tools, costs you $10,000 per manufacturer per year. If you want to modify your car so your own mechanic can fix it, that's illegal. If you want to modify your tractor so that you can fix it instead of having to pay a John Deere technician to come out and type an unlock code after you've done the repair yourself, that's illegal. If you're a hospital and you want to modify your ventilator from Medtronic, the largest ventilator company in the world. They pretend they're Irish so they don't have to pay taxes, but they're an American company. If you want to modify it so that when you take a screen out of a dead ventilator and put it in a working ventilator with a dead screen, without waiting for a Medtronic technician to come to your hospital and, again, type an unlock code, that's illegal. If you want to modify your phone so that you can choose which apps go on it, that's illegal.
All right, so are there any other countries that do what we do, or are they more liberal?
Well, so here's the thing. The U.S. passed a law, the first of these laws in 1998, the Digital Millennium Copyright Act. Section 1201 is the thing that makes this a crime. And you can see why they might do that, right? Because American tech companies make a lot of money ripping off Americans by locking them into these technologies. But of course, if we could export the tools to unrig your printer, unrig your tractor, unrig your phone, well, then we could turn their trillions into our billions. So the U.S. Trade Representative went to every single trading partner of America and said, if you don't pass a law just like ours, we're going to hit you with tariffs. So, happy Liberation Day, right? If someone threatens to burn your house down unless you do exactly as you're told and you do it and they burn your house down anyway, you're kind of a sucker if you keep doing it. So now it's kind of a race to see which country will get rid of these laws first and become the country that exports the tools to everyone else, that lets them get more out of their own property, and that takes some of those gigantic margins American companies are earning and puts it in a domestic firm's pocket. Jeff Bezos has always told his suppliers, your margin is my opportunity. Well, when he does it to other companies, that's not piracy. If we do it to him, it is progress.
So is there a country that's maybe close to doing or leading the way and already in the process of?
Well, Malaysia just tore up all their trade agreements with the United States, and they know a thing or two about making electronics and high-tech products. But as far as I know, it's still a race to be seen who gets there first. There's the European Union is building this thing called the Eurostack, which are equivalents to all the U.S. tech exports that run on European data centers in the European Union. The problem they're going to run into is that getting the data off of those American platforms and into a European platform is going to require circumvention. They're going to have to jailbreak these things so they can get the data out. And right now, it's kind of like they're building really nice public housing for people in East Berlin, but they're building it in West Berlin. And eventually, they're going to have to tear the wall down because no one's going to risk getting shot in the back to move into even a very nice apartment.
Now, it wasn't part of the reason these were brought in was to keep for security and cybersecurity by protecting software and codes and things like that? Is there not a danger now you become more vulnerable if we open it up?
Or no, it's the opposite, right? Because right now, if a company decides that something that's wrong with its product is something they don't want to fix, if there's a vulnerability they don't want to patch, or if they deliberately introduce defects, so you think about these American products that steal our data, right? That's obviously a defect in the product if that's how it works. Unless the company decides to fix it, you're out of luck. And what's more, when security researchers discover defects in products, revealing the defect to you and saying, hey, that pacemaker that you trust, that automotive informatics system that you trust, it's actually really dangerous. And a third party could break into it and ruin your life or steal your data. It's illegal to go public with that information because you might help someone jailbreak the product. And so you have this kind of fool's paradise where the bad guys can figure out what's wrong with your products and the manufacturer knows what's wrong with your products, but you and you alone, the person who relies on those products, you're never allowed to find out about it until, your life has been destroyed.
That was Cory Doctorow, Special Advisor at Electronic Frontier Foundation. Up next, with trade talks approaching, Prime Minister Mark Carney is ruling out using Canada's resources as leverage, which is drawing fire from the Conservatives. We've got more on that after the break. With trade negotiations looming, Prime Minister Mark Carney is pushing back on the idea of using energy and critical minerals as leverage, a stance now drawing sharp criticism from the opposition. CTV's Jeremy Chiron has more in this report.
With a mid-summer deadline fast approaching to review Canada's free trade agreement with the U.S. and Mexico, Conservative leader Pierre Poilievre had this question today.
So if energy and minerals are not going to be leverage for Canada in these negotiations, what leverage does Mr. Carney claim to have?
That's after the Prime Minister told the Canadian press this week Canada won't leverage our energy resources or critical minerals in trade talks.
Let's be clear, we're never going to cut our American allies off of our energy or selling our resources, but we can offer in the negotiations to build up our resources in a way that helps our continental security, that keeps both of us safe, strong, and rich.
The Prime Minister has so far signaled he's in no rush to negotiate a new deal ahead of the July 1st review deadline.
You're best to wait for the right agreement as opposed to rushing into something because of the potential permanence of that.
This former special advisor to Prime Minister Justin Trudeau on Canada-U.S. relations believes time is in Carney's favor.
We have no idea what the conditions of the coming months are going to look like, what domestic American pressures are going to be felt by the president and his team, what geopolitical priorities are going to take precedence over that of a conversation with Canada.
With U.S. midterm elections around the corner, Trump's Republicans could lose control of Congress in November, leading to speculation the Prime Minister could be waiting to see if that happens.
There's a lot of speculation here that Canada may be waiting it out.
But in an interview with CTV's Question Period, Colorado's governor says that's unlikely to make a difference.
Sadly, having served in Congress 10 years, I have to tell you that's not really the way our system works. We give tremendous authority to the executive in negotiating these kinds of agreements. Pressure, yes, but I don't think this president gives into that pressure.
Now, that July 1st deadline is not to get a new deal done, rather just to decide whether to review the current one. And right now, neither side appear to be in a rush.
That was CTV's Jeremy Chiron. Well, that wraps up this edition of Trading Day. Thanks so much for watching.